Hello and welcome to another episode of Enter the Boardroom with New Role, the business-oriented podcast that brings the boardroom to you. I'm your host, Oliver Cummings, CEO of New Role, the board search specialist and market leader. Today, I'm delighted to be joined by Jeremy Asher, CEO and chair of Tower Resources plc, and Sid at Block Energy plc, two AIM-listed oil and gas companies. A graduate of the London School of Economics and Harvard Business School, where he was a designated Baker Scholar, Jeremy is also chair of Agile Energy Limited, an investment company focused on the energy sector. Previously, he's been an advisor and director on the boards of Oil Refineries Limited, Gulf Keystone Petroleum Limited, Pacific Drilling SA, Better Place LLC, and Process Systems Enterprise Limited, where he's appointed by Imperial Innovations, the commercial arm of Imperial College London. Over the course of his executive career, Jeremy has gained a wealth of both strategic and operational experience in the oil, gas, and energy sectors. He ran the global oil products trading business at Mark Rich & Co. He acquired, developed, and sold the 275,000 barrels a day Beta oil refinery at Wilhelmshaven in Germany. And as CEO of PA Consulting, he oversaw the organization's globalization and growth from 2,500 to 4,000 staff. Jeremy's experience as CEO, advisor, director, and chair give him a brilliant perspective on executive and non-executive dynamics, particularly the relationship between the chair and CEO. And his experience of volatile markets with varying degrees of regulation give him a particular insight on what he describes as good governance on a shoestring. Jeremy, a huge welcome, and thank you so much for joining us today.
My pleasure. Glad to be with you.
Jeremy, I'm really interested in this idea of good governance on a shoestring. What does that mean in practice?
Well, one of the things about the AIM market is that one is expected to adhere to the principles of governance as for a FTSE 100 company, but one's given the dispensation to modify them for the practical needs of a much smaller company. And this is partly a matter of saving money, but also it's a matter of responding to the fact that what would work for a very large company and what's needed for a very large company isn't necessarily the same for a much smaller company. So what I mean by that, I think what AIM means by that, is to achieve the same standard of governance that you'd find in a much, much larger company and having the same values in terms of governance, but doing it without the huge staff and the huge expenditure that a FTSE 100 company would throw at these things.
And so what do you think is the return on that additional investment those larger organizations get for that extra governance? Do you feel like you miss anything in that AIM governance those larger institutions have?
I don't think so, no. And I say that for two reasons. The first is that I don't think that it's a matter of extra governance in the sense of more or better. It's simply that when you've got an organization of 10,000 plus people, how you manage what all those people do is a very different problem from when you've got a dozen employees or less. So obviously you need different kinds of controls and different kinds of controls on the controls. Also, I would say that when you're looking at a small company, in some respects, you can naturally even achieve better governance because it's simply much clearer what's going on. When you look at things that go wrong in big companies and small companies, you find that sheer size is not a protection against problems. And furthermore, a lot of the effort that goes into governance on both sides of the Atlantic, including Sarbanes-Oxley as well as the UK Code, it's still not enough to stop bad things happening. Just take a look at Wirecard, for example. Even apparent bastions of what should be best practice, like some of the banks, regularly seem to wake up with their sort of shoes on and their laces tied together and fall straight across the floor.
I talk to a spectrum of people who have a spectrum of people with a spectrum of views about what governance is, and ranging from those who think it's a sort of necessary evil to those who think it's a empowering and enabling asset to any organization. It sounds like you're very much in that latter camp. What does good governance mean for you?
I think it means honesty and transparency. But also, one of the caveats to that is that there are inevitable limits to how transparent you can be with the markets. And therefore, exercising good judgment over what is really in the company's interest to disclose and not to disclose. This is an art. It's an art that you have to get right.
One of the things that jumped out at me as I was sort of preparing for this discussion was that you have the unusual position on one of your boards where you are both the chair and the CEO, much like many organizations in the US, where that's much more common. How do you think about the advantages and disadvantages of that compared to, your other boards where you have an independent chair?
Personally, I don't think it makes a huge amount of difference in our case, but that wouldn't always be the case. I well understand the reasoning behind having the dual roles of chairman and CEO. When I was a trader, and this, of course, is in a non-public company environment and at a lower level in the organization. But one of the things that the company was a big believer in was the idea of pairs of people, that two people working together would both complement each other in terms of skills, but would also provide good sounding boards to one another and would lead to better decision-making. And I think that that's part of the thinking behind the merit of having separate chairman and CEO. And it's still good thinking, whether it's in a public company environment or not. Having said that, if I compare our position at Tower with our position at Block, where I'm the senior independent director, Phil Dimmock is a non-executive chairman, Paul Hayward is a CEO, the fact is that we are sounding boards for one another in exactly the same way as Mark Enfield and Paula Brancato are for me as my fellow directors at Tower. The dynamics are the same, the titles are different, but it doesn't change the fact that I know I need a sounding board, and they know that it's their duty to provide that sounding board and that oversight of what I myself am doing. Combining the chairman and the CEO role is simply a practical way to deal with the way we deal with external people, for example, with our licenses and so on, to make clear that they're talking to the boss when they're talking to the boss, which is an American sort of way of looking at the world, but I think also has its advantages too. Even in America, where you have a chairman and CEO, it doesn't mean that the chairman and CEO is not accountable to his directors or her directors, and in particular to the senior group of those directors who have to make the decision about whether he or she is doing a good job.
And how do you manage the different responsibilities of those two roles? I mean, I find it hard enough just being a CEO. And so by the time I sort of come to thinking about my board, I'm grateful if the chair is sort of driving, the thinking and has that ability to step back. I've got my head down in the weeds. How do you manage those sort of dual responsibilities and the challenge of that, both being in the day-to-day, but also providing the sort of the altitude perspective?
One of the problems that one has in a small business is dealing with the indivisibility of people. It's an old concept, the divisibility of labor. And boy, you feel it when you're running a small business, because if you try to have one of everything, a CFO, a company secretary, going to the technical level in our business, a geophysicist, a geologist, a petroleum engineer, a mechanical engineer, a blah, 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 blah. The problem is you have a number of people that is far larger than what you actually need for the jobs that you need doing. They're not full-time roles, not in a smaller company. And that leads to all kinds of difficulties. Putting aside the cost of trying to pay all those people, you're also not going to attract the best people if you can't really keep them properly utilized. Now, that's why we outsource significant amounts of things. We try to have the best of both worlds on a lot of technical functions by outsourcing in a strategic relationship with EPI Group, our G&G work, for example. So we have access always to first-class geologists, geophysicists, and so forth as we need them, but we're not paying for them all the time. But I think that also applies even at the highest level. If you have a whole bunch of people on the payroll who are not fully employed, first of all, it's financially inefficient. And secondly, even if you can afford it or your shareholders are willing to pay for it, you're not going to have the best people working in the best way if they're not properly challenged. So as a result, my own view is, there is time for these things, because although we have a lot going on at Tower, the fact is that being chairman and CEO are not the only two roles I play. I do plenty of other things as well, and so does everyone else in the team. We all multitask to cover what needs to be done, because at the end of the day, there simply isn't enough to justify a facilities manager or, a real estate manager or whatever. So between myself and the rest of the team, we have to divide these things up and take care of them and do them well. And if we need outside help, we get it.
Yeah, really interesting. That's definitely something we see on the platform, and that organizations, typically sort of AIM-listed organizations where they have got smaller boards, require more of the board members. They require more, they've got less room to carry someone who cannot cover all the bases versus, if you're a big sort of FTSE 100 board, you can have one or two members who, are carried in certain respects by others. What are the key challenges that you face as a board member of an AIM-listed company where that requires that sort of broad sort of coverage of skills?
I've been director of quite large companies as well. And the first thing I would say is that all roles as a director are actually quite intensive if you do them right. You always have substantial obligations and responsibilities. I think that with large companies, the board meetings are usually more formal and sometimes rather less frequent, but not necessarily. There's a sort of quarterly board meeting cycle with very large companies, but then the board meetings take days and require a lot of preparation. I understand why that's done that way, but I'm not a huge fan of it. But that's very much an Anglo-Saxon thing. In other countries, I've also been involved with boards that do meet at least monthly. So the idea of frequent interaction is not unique to small companies. But what I would say is my experience is that with smaller companies, you meet more regularly, and it's good to meet more regularly. And furthermore, I'm a big fan of meeting outside of formal board meetings. You need to have formal board meetings on a regular schedule, whether it's quarterly like the, biggest companies, or more frequently because you've just got more little things that should be reviewed formally by the board. But the fact that something doesn't require a formal board resolution doesn't mean the board shouldn't be discussing things. And the other thing I feel is that we're all busy, and whether it's with other executive duties or with other things in our lives. And therefore, if you're going to have board meetings more than once a quarter, you really still want to try to avoid having those meetings go on for days. And the best way to do that is to ensure that people are well informed all the time. Finally, I think that engagement and trust are very important, running both ways between the executive and the directors. And the way, again, that you achieve that best is by talking frequently and in real time about what's going on. That way, you get a sounding board that's useful while ideas are still being shaped, rather than having a situation where, yes, you brought it to the board, but it's already kind of more than half-baked. And it's difficult to sort of backtrack and say, oh, gosh, yeah, that's a different approach. We should try that. So I'm a big believer in talking to my fellow directors regularly, continuously, whether with my director hat on or chairman hat on, or whether with my chief executive hat on. And again, that's what we do at both Block and Tower.
Takes me back a little bit, actually, to my days. I come from an investment background originally. We used to sit on boards as investor directors. And I think there were times when, we were super hands-on and involved outside of the boardroom. And I think there were times that we were guilty of taking up so much of the executives' time that they didn't have time to actually get on and run the business. And sometimes it felt like we were so busy engaging with each other that the business drifted on in the background. Is there a point where it can be too much? And have you experienced that? I've certainly sometimes as an executive experienced that, where, the frequency has been, of engagement with my chair has been so much that I felt like I haven't had time to get anything done since the last time that we spoke. I mean, what's your take on that?
The one company where I really felt that the executives were pushing back was a situation where I felt they were pushing back because they didn't want proper scrutiny. And it was right to keep pushing for that proper scrutiny. But obviously, you're correct that there's a limit. And, there's a certain point at which the non-executive director has to, accept that they're not running the business. They're there to provide supervision. But, it's not that difficult to provide information. And if you ask for something and people don't have the answer, that is itself a bit of a red flag. If it's causing a lot of difficulty to answer a question, it may be that the question's completely wrong-headed, but it may also be an indication that not enough thinking has actually been done. I would also say that I've also seen the opposite, particularly with financial institutions who have representatives on the board of companies, which is to say that you were talking about passengers earlier. Sometimes people who are representing a financial institution are under very specific instructions to listen but say nothing at board meetings in order to avoid potential liability. And that, I think, is also rather counterproductive. The one example that I encountered of it, which I won't mention, but I will say that the individual involved had a huge amount to contribute. And privately, we would talk very openly about things we, felt should be discussed in the boardroom. That individual was never the one to say it because he was under strict instructions not to. So I think that none of this is good. If you have real honesty, trust between the directors and the executive, none of this should be a problem. You ask a question, there should be an answer. If there isn't an answer, there should be a reason why there isn't an answer. It should be okay to say, I think that's the wrong question to ask, because it should be okay to say, we haven't thought of that. We'll think about it. This is a tricky enough role, being a non-executive director, without it being made worse by defensiveness on either side. What you want is honesty and trust, and then it should be a very positive process for everybody.
How does that extend to your relationship as a sort of AIM board member with the investment community? I guess a certain amount of your time gets spent, attracting and retaining investors and managing their expectations and ultimately accessing additional capital from time to time. How do you think about that relationship?
I think that it's good to talk to your shareholders. Now, the only thing is one has to be a bit cautious with non-public information, and the investors themselves, the institutional ones, are often reluctant to actually talk very much with the directors for the same reason. So it's a bit odd when you want to talk openly with a shareholder to sort of get their view about something you're thinking of doing, and they don't want to talk to you because they're afraid that that's going to make it impossible for them to trade the stock. That's the reality of the world we live in. Private investors have generally no such qualms. They just want to know everything all the time. But again, one can't tell them everything because it's not just that some information is price sensitive and some is not. Generally, most non-public information is also not price sensitive, but it's commercially sensitive. And one of the problems is that when you're engaged in commercial discussions, whether it's over a financing transaction that's off market, or whether it's a bank line, or whether it's a term contract or something, the fact of the matter is that you can't, it's like being asked to play a hand of bridge with your cards face up. you can't do that. You have to preserve some competitive tension by ensuring that it's not completely obvious to everyone you're talking to what's going on with everyone else you're talking to. And so if you start sharing every detail, every aspect of a contract negotiation with your shareholders, you have to do it with all your shareholders. And that means also with the people you're talking to and their competitors. So there are limits to how much one can share. And finally, I'd say that people can get into big trouble, even with the best of intentions, in trying to discuss with shareholders things that they really shouldn't discuss. There was examples quite recently, I can't remember, but a very well-respected company chairman got himself into big trouble with the FCA because he was trying, and even taking full legal advice and so forth, to consult with some key shareholders about a critical decision ahead of communication to the market. And, he was very severely criticized for it. But it was pretty apparent to me that the individual concerned was actually trying to do the right thing. So it's very tricky today. And the advice you generally get is just don't talk to shareholders if you can avoid it. I do my best not to do that because I just think it's disrespectful. But I do ask the people who I do speak to bear in mind this issue and to respect the fact that it's not just a matter of, if I know it, I must tell you. It's a matter of, is it in the company's interest for this to be out in the public domain? And often it isn't.
It reminds me, actually, I used to sit on a board where we had one of the company's key customers also sitting on the board as one of the major shareholders. And it was an absolute nightmare for them because they were trying to negotiate contracts with them at the same time as having them sort of having full visibility. And so I guess it sort of created a very similar dynamic to the one that I suppose you face as a publicly listed company with everything out there.
Which we also run into anytime we want someone on the board to participate in a placing. Investors love it when directors participate in placings, but it raises a related party question every time.
Really interesting. I've never sat on a listed company. If someone's listening to this who's in that position, what has been your experience? What have you learned over time from sitting on in that sort of listed company environment with the regulatory requirements that you didn't know when you started and you wish you had known? What have been the key sort of lessons for you?
I think that in the main, following your own moral compass does usually lead you to the right place. However, the problem is that one needs to be well informed about all the potential consequences of the decisions that you make. Something can feel right to you, but if you don't fully understand how it affects one or another of the different stakeholders, then even if it feels right, it may not be right. So the problem is you really do have to talk to people and look at things from all angles when you're facing anything that's not obvious in terms of a choice.
It sounds like you take a very sort of common sense, practical approach to a lot of this stuff. I'm always interested by the sort of the audit and risk committee and how people use that. Could you give me any examples of where your sort of audit and risk committee has actually added commercial value?
The main object of an audit committee is to avoid the destruction of value. And I think, they generally work. However, the exceptions are horrible. Sometimes I think that one of the more useful things that the audit committee does is actually it's the risk management function. And the prevalence more recently of risk matrices and sort of the having a risk management process, even in small companies, I think is useful. However detailed a risk management framework you put in place, even for quite a small end company, you need to list your risks in the annual report and so forth. So there has to be a framework for thinking through risk. And there are things like insurance and hedging and so forth, which often don't get thought about in the daily grind of operations, which the audit committee process can provide an opportunity for. And, these kinds of opportunities to manage risk obviously can be very valuable too.
Interesting. I mean, I was struck by the SVB crisis, how many organizations had a single point of failure in their sort of cash, or having all their cash with a single institution, and not just cash, but also their ability to pay employees, their ability to receive payments from suppliers. And it sort of made me think, gosh, what are all their audit and risk committees doing? And how have they not sort of identified that risk? Are there things like that you've come across where you think actually there are lots of audit and risk committees missing risks that are very sort of obvious that you've sort of picked up on over time?
That could be. I have to say, I have some sympathy for the depositors in SVB, because one of the things that you've surely noticed is how difficult it is to maintain multiple bank accounts. Now, we have a few different banking relationships, but both Block and Tower, but that's mainly because of the different countries where we operate. But it's not easy to have multiple bank accounts in a single country these days. The banks themselves don't particularly like a dormant account. They want your business. Plus, the amount of KYC required just to maintain bank accounts these days is enormous. So it's not the easiest thing to go tell a beleaguered finance director that high on his list of priorities should be opening another couple of bank accounts, just to handle cash balances. And as I say, there are often requirements anyway associated with the banks themselves and their financing proposals that tie you into them. So you wind up having everything you want. The more interesting question to me is the risk management process at SVB itself, which felt to me, frankly, a little bit like Northern Rock in Chinos. The Northern Rock process, as you may remember, it was subtly different, but it was about, what SVB were doing is they had deposits and then they were lending long. Now, in Northern Rock's case, they had deposits and they exacerbated the problem, as I recall, by borrowing from the short-term money markets to lend long. But it was the same mismatch of maturities that was the problem. And in both cases, it just seems to have gone completely under the radar. There was a very good article, I think, in the FT about the failure to see the maturity mismatch issue at SVB, failure both by the bank itself and by the appropriate regulators in the US. But, I just have this really strong view, perhaps it's because I'm a former trader, that you really shouldn't have boards that don't have at least one proper trader on them. Because if you haven't traded something and you don't understand, the impact of markets in time and space and quantum quality, if you don't understand the risks that are created by an apparently balanced book, that no book is really balanced, I don't see how you can make intelligent decisions. And I really have the feeling that in a lot of these enterprises, the people at the top truly didn't understand what was going on or the risk that was being taken to generate the profits that were coming. And they were happy just to let the profits roll in and say, oh, yes, so-and-so is a genius.
I'm curious to understand what your experience of being an AIM board member, how that's evolved over time. Has it changed in the time that you've been a board member? Have certain things got better? Have certain things got worse?
I wouldn't say that much has got better, but I don't think that things have got worse in a way that's not understandable or one should complain about it.
Mm-hmm.
The regulatory burden has risen a bit. I would also say, and this may not be popular, that the regulatory burden on AIM directors is not that great, and that AIM has made a real effort to regulate through nomads and the AIM team with a light touch.
Yep.
So, we are given a lot of dispensations to figure out solutions that work for us.
Mm-hmm.
I think that one thing I've noticed has been that D&O insurance has grown more and more expensive. I think that market's finally peaked out and is getting a little more reasonable this year, but that certainly has been a frustration. But more generally, I think that one of the biggest difficulties facing, I would say, small cap companies, and especially in oil and gas, but small cap generally, And AIM is not just small cap, as you know, so I make that distinction. But with small cap companies, the Woodford problems really led a lot of institutional investors to withdraw entirely from the small cap sector. And that's led to a whole host of problems, not just in terms of raising capital, but in terms of price discovery in the market, the quality of the market and the liquidity in it. You don't need many sophisticated investors to provide efficient price discovery. But if you don't have any there, and there isn't a lot of good independent research, I also think, by the way, this is a negative, unanticipated consequence of MiFID.
Yeah.
You simply have fewer benchmarks and fewer safeguards for prices to drift off into irrational territory, both up and down. I don't think this is a new problem. And in fact, some of that problem has been mitigated over the last decade by tighter disclosure rules and more sensitivity about disclosure. But some aspects of it have got worse because when you knew that in your sector there are a couple of well-informed people who would be buyers of the stock if it got too low, sellers of the stock if it got too high, you don't have that protection. And more importantly, small investors don't have that protection anymore. So I think that's something that's changed for the worse. I don't think it's an AIM problem. I don't think it's AIM's fault. I think it's a small cap problem.
Yeah, it feels very topical at the moment with so many UK listed businesses being attracted off to the US for that additional liquidity and access to capital and a slightly different mindset with the way they think about investing.
Well, that's true, but the US markets, they're the deepest capital markets in the world still, and they're wonderful from that point of view. But the cost of operating in that environment is significantly higher. The total cost of audit and compliance with Sarbanes-Oxley and so on, if you want to be on NASDAQ, is minimum $1 to $2 million range and arguably more. And the problem is that that's very difficult to justify in small cap world. Now, arguably, it's a bit of a chicken and egg problem. Some small cap companies would say, yeah, but we're hopelessly undervalued. If we were valued properly, it wouldn't be an issue. But I do think that there ought to be a good market for companies that genuinely are small cap. And they cannot afford US level compliance, even if they would benefit from US type depth of capital markets. It's an unfortunate gap, but there it is.
Very interesting. I want to move on to talk a little bit about the executive, non-executive dynamics. A wonderful piece of research I came across recently where they showed that only 29% of executives rated their board's overall performance as excellent. The vast majority thought their boards were underperforming. The other side of that coin that we see through mastermind groups that we run for board members to swap experiences and learn from each other is that one of the most commonly recurring challenges is dealing with an executive, and often it's a CEO, who's just not listening, has got their head buried in the sand for one reason or another. What have been your biggest challenges navigating that executive, non-executive line? And you've done it from both sides, separately and together.
Well, I'll take what you say as read on the performance of boards, but my own view is that if 29% of boards are functioning excellently, that's pretty good. I mean, we don't want grade inflation in evaluation of the boardroom. The issue is how many are good, not good, and bloody lousy. But let's assume that the bulk of the 71% are indeed unsatisfactory.
So there's another stat to add to that, which is that 90% of executives think at least one of their board members should be replaced.
Yeah, well, they're probably right. But I think that, first of all, a well-functioning board isn't always going to be in perfect agreement about everything, but there should be enough trust and goodwill to reach consensus about things. And ideally, you don't have passengers on the board. But when it comes to then how deep do you go, we talked about that a bit already, the balance in deep executives, not just the CEO, in not being a complete pain in the neck, but at the same time, asking the right questions and making sure that things are properly thought through. And, when there is a big problem, whether it's on a smaller scale like Patisserie Valerie or a bigger scale like Wirecard, first question everyone's asking is, why didn't the directors know? Why didn't they ask? So you have to allow directors to follow those red flags. Having said that, does the CEO listen? Listening is a two-way street. Yes, it requires the CEO to listen. It also requires the board to deal with the CEO in the right way. And I think that you need to build trust. Trust doesn't just happen. Hopefully, people start with trust. They start with an assumption that they can trust someone on their own board or they can trust their CEO until proven otherwise. But even with that benefit of the doubt, trust is something that gets built over time. And
how do you go about doing that? How do you build trust in your board? Do you have a formula?
By being honest. It's simple as that. You have to be honest. I also think that...
What does honesty mean for you? What does that mean by being honest? Is that radical transparency?
Explaining when one's worried about something and why. And, not sort of just smiling at people all the time and telling them they're doing a great job and when you don't think they are. But also, there's something else, which is there's a cult of certainty in leadership, which is a very natural thing. It's human. I don't think this is a modern thing. We like our leaders to be certain. I don't. I actually don't like it. I'm quite alarmed by it. I like my leaders to be decisive, but I like them to manifest, at least within some group, a degree of uncertainty and then exercise decisiveness. And there's a big difference, because if you're certain all the time, then you're not listening and you're probably going to be wrong quite a lot. And, I remember someone in the US military saying to me, yes, but a bad plan well executed is still a good plan. And he's right. I mean, decisiveness is important because you've got to have a plan executed, even if it's not the best plan, and you shouldn't let perfect be the enemy of good or whatever the saying is. Nevertheless, a bit of humility and a bit of, I'm really not sure about this is really appropriate before you jump into making a decision.
Yep.
And one of the important things is to let the CEO know that it's okay to have that uncertainty. And it's okay to discuss with the board and say, I'm really not sure about this. That's not some terrible admission of weakness or, a need to be replaced because can't, see the immediate solution to the problem. To the contrary, in my view, that's a strength of thinking process.
It's amazing how many CEOs are afraid to be open with their board because they fear that it shows weakness. And that's, as you say, a disaster in terms of the board being able to add value.
And that's why I have those frequent discussions with my board as a CEO and a chairman, because I want them engaged and understanding my thinking as it evolves so that I can have their input into that thinking. And I share very openly with them when I'm not sure about something. And you can't control everything either. So again, it's important to be clear with people about what you can control, what you can't control, and with yourself. And to be clear when you're trying to manage something that you're controlling versus when you're trying to manage the potential reactions to something you don't control. So I think that this is something one needs to be open about. Now, one particular problem with startups is that CEOs running startups are often very heavily invested in the particular vision of the startup to the point where, frankly, a degree of narcissism is even a positive in getting a startup over the line, because you have to be really determined to stick to your worldview in the face of an awful lot of people telling you it can't be done. So you have this situation where CEOs often are and have to be a bit thick-skinned about objections to their worldview. And again, there's nothing better, in my view, than talking about this openly, because the truth is that you don't want to undermine the confidence of the CEO in their vision. And yet at the same time, there's some aspects of that vision that do still need to be questioned from time to time. And the CEO himself or herself have to be self-aware enough to say, okay, it is all right, in fact, important to question at least some of these assumptions some of the time.
Reminds me actually of a book I was reading recently by Annie Duke, who's a sort of former poker player turned investor, and she draws this distinction between gritting, and quitting. And she looks at sort of what makes the best professional poker players in the world and the differences between them and the amateurs. And the answer is that they quit, they fold much more often. So they make sure they only play the hands where they've got a high probability of winning. And it's, amateurs sort of fold 56% of the time, whereas professionals will fold 10 to 20% of the time. And it strikes me that there's a sort of parallel there. And she talks about that tension between, the importance of persevering, gritting, keeping on going, but also knowing when to quit, which seems to be the essence of what you're talking about there.
I completely agree. Emotional resilience is very important in any business situation, but the smaller the company, I'd say the more important it is. Your story reminds me of another one I was told by a professor of psychology at London Business School, who'd been doing some work with an investment bank on what made different traders more or less successful. And he devised a trading game. And as I was listening to this as a former trader, I was thinking, oh, for heaven's sake, I almost rolled my eyes. But he said, I devised this trading game. But then he told me the twist. The twist was the trading game didn't really work. And the issue wasn't whether you did a good job of reading all these headlines coming in and buying the grain or selling the grain or whatever. The real point of the test was see how long it was for you to figure out nothing you did made a difference. And,
love that.
And that is a very interesting cognitive issue. As I said at the beginning, you can't and you don't control everything, but understanding what you don't control is critical.
Yeah, there's the wonderful Warren Buffett has that story of the coin tossing competition where everyone calls heads or tails, and after sort of 5 rounds, if you started with the whole of the population of the US, you've got some people who've got everyone right after 5 rounds, and they start writing books and they start, selling their tips on how to call a coin toss right. And of course, it's just classic confirmation bias work.
I think is this.
Yeah, survival bias. I'm interested to know how you think about your own performance as a chair. Do you set yourself sort of objectives, and how do you sort of track and evaluate your performance?
Well, I judge myself by the quality of my interactions with all my fellow directors and the executives. But in the case of Tower, there are none. I mean, it's, me as chief executive. But if I'm getting honest feedback and people are relaxed talking to me and saying to me, you sure about this? And have you thought about that? Then I think, okay, we're doing fine. And if they're taking my calls and replying quickly, and when I ask them a favor, they're responding quickly, then I'm doing fine. And if people are not asking me those questions, they're not being open with me, I don't think, oh, no news is good news. I'd ask why, but that hasn't happened.
Yeah, interesting. One of the challenges that comes up regularly in these mastermind groups that we do is what you do as a non-exec if the chair is not performing. What would you do as a non-exec if you were sitting on a board with an underperforming chair? How would you approach that?
In general, my first reaction would be to try to be as supportive as possible to the chair, because you don't know what might be the reasons for the issue. I mean, if the problem is that one feels they're not putting enough time in, or that they're sort of gotten into some interpersonal issue with someone or something, these are potentially fixable things. And so, I would certainly say the first thing you try and do is be supportive. Having said that, you will encounter situations, I believe, where, for whatever reason, there's some more fundamental problem. And if there's a fundamental problem, well, maybe you can resolve it amicably. But the first step is to make sure your perception is correct. So you need to share that view with other NEDs, test it out, see whether there's a consensus that there is a problem. and share it with the chair himself or herself and say, look, how can we fix this? But if you really get into an outright dispute, then you have either boardroom battle or proxy battle, and we've seen them. I joined Block's board in the middle of a proxy battle, and I had a similar proxy battle to deal with at Gulf Keystone. And, in the end, shareholder democracy only means anything if, when the chips are down, shareholders are prepared to act if they're uncomfortable with the board and what it's doing. In that sense, I have considerable sympathy with activist investors, but also the board themselves have to do their best to address these issues themselves, because really it's not for the shareholders to decide who the chairman is, it's for the board. But unfortunately, some boards are not very functional in that regard because the chairman's stuffed them with cronies or they're stuffed with executives. That, by the way, is very rarely a problem in the US. It's something I've noticed. It's true that the chairman and CEO are often combined in the US, but the usual format for a US board is to have just the chairman and CEO and maybe the finance CFO on the board. And then you have a whole raft of non-executives who massively outnumber the executives. So that particular problem with a board dealing with the chairman doesn't usually arise.
Interesting. I'm interested to build on that because one of the other things that struck me as very interesting on at least one of the boards that you've offered equity in lieu of sort of basic salary. And again, this is another topic that comes up quite regularly in these mastermind groups where sort of NEDs have been offered equity instead of basic cash and they're not quite sure what to do. And on the one hand, I see equity incentive of NEDs is a very positive thing. It means they've got skin in the game. And, as Warren Buffett, amongst others, has argued, directors with stakes in the companies they serve are highly incentivized to give good advice, even if they're not sort of considered independent for corporate governance perspectives. On the other hand, you have got, the UK Corporate Governance Code arguing against any performance-related remuneration, including shares and options, because of the conflict of interest that it introduces, that you're there to represent all stakeholders, not just the equity holders. How do you think about that balance?
What I would say is that I'm not going to suggest that the UK Governance Code is wrong, but I would also suggest that it's quite presumptuous to suggest that the entire US approach to these things is wrong too. So let me just say that perhaps the UK Governance Code is not entirely correct, perhaps. The argument I understand very well about the directors being there to look after all the company stakeholders' interests and so forth, and above all, the company itself, which is distinct legal personality from the interests of the shareholders.
Yep.
What I would say is that when you were company director, you're acutely aware of the potential negative consequences for you if things go wrong and the company winds up insolvent and so forth. Now, prosecutions and so forth may be pretty rare, but nobody likes being in a situation like that, even if the reasons are actually perfectly respectable. And especially, no director wants to be in that situation where the reason is because, for some reason, any debt holder, employee, or other stakeholder, the obligations to them have not been complied with. So I would say that there's already a strong sensitivity to that. And whether or not you happen to have some shares in the company is not going to mean that you all of a sudden say, well, what the hell? Let's just, ignore our environmental liabilities. I mean, I think that anyone who's lived with the obligations of being a company director would find that a bit odd. Now, there is a difference between complying with the obligations to stakeholders, which generally are defined obligations, and the residual obligation to shareholders, which is an unlimited obligation to maximize the long-term value of the company for shareholders and for the company itself. And that is why I do incline to the American view that there is a difference, that they're both important obligations, But there is a qualitative difference between the director's obligation to shareholders and the director's obligations to the other stakeholders. And it's not that one trumps the other. The fact of the matter is that when things are difficult, the order of priorities means that the stakeholders' obligations are more important. And what's more, it's not just as simple as that, but different stakeholders' obligations rank differently in a difficult circumstance, and the directors have to take responsibility for that as well. So to say that it's as simple as, you've got to look after all stakeholders, and therefore you mustn't have any alignment with shareholders, that makes no sense to me. Now, on the other hand, it's a staple part of the American approach to director compensation that they should have both an element of compensation paid in shares. And by the way, there's a difference between shares and options here. And also, there's often minimum shareholding requirements so that directors can't just take a disinterested attitude and say, oh, well, things are looking a bit dodgy. I don't want any personal liability, so let's just stuff the shareholder interest and throw a whole bunch of money at making this problem go away. Because that's not appropriate either.
And how do you think about that sort of, Buffett mantra there of that directors should have to buy in, not just be awarded their shares, but actually having to sort of commit? I mean, do you see a big difference there between those two things?
Yes, I do. That having been said, though, I would say that if you convert compensation into shares, that is buying in. Because, again, anyone who's been a director of an AIM-listed company knows that it's a lot of work.
Yeah.
And you don't get paid that much for it. So I don't think they're being underpaid.
No.
So if you take the rather meager fees that the typical AIM director is being paid and you ask them to forego those in return for shares, I think that's real payment for shares.
Okay.
And I think that's what the tax man would say as well, by the way.
Yeah. Jeremy, the time has flown by. I can't believe it. It's time to move on to the 5-question quickfire, where I say a short statement and ask you for a quick response if you're ready.
Very good.
So the best book that every board member should read and why?
Well, there are many best books, but the best book I've read lately was Flash Boys. It was pre-pandemic, but I thought it was really good to understand what's going on under the hood of the traded equity markets. And I think that's a valuable thing for all directors of public companies to understand in thinking about what's going on with the share price.
Fantastic. I'll have to look that one up. I've not come across it. Favorite quote and why?
Oh, Michael Lewis. It's Michael Lewis' book.
Fantastic. Your favorite quote and why?
It's not as good as you think, and it's not as bad as you think. I think this is very important for keeping perspective on events, and it applies whether you're a company director or a football supporter.
Well said. Best ever holiday and why?
Portofino in 2012, because it was my honeymoon.
Fantastic. Your most significant professional insight?
We talked about this a bit earlier, but it's that you don't control everything. And so I think you have to be clear about what you don't control, what you do control. Focus on what you can do and control yourself. And of course, that includes how you react to the things you don't control, but you don't want to mistake that for imagining that you can really influence the things you can't control.
Fantastic. And last but not least, your favorite podcast or app if you don't listen to podcasts?
It's a bit boring, but I've been really impressed with the news coverage from Bloomberg, the way it's evolved over the last couple of decades. I think that the level of quality of some of the articles on Bloomberg, the things they cover, ranges way beyond what it used to be. And often they have articles on things which you just didn't find anywhere else.
Brilliant. Jeremy, thank you so much. This has been a fantastic education and discussion, giving a brilliant insight into the life of an AIM board member, amongst many other things. So thank you so much for taking the time.
My pleasure. Thank you very much.